Hey everyone, welcome back to Corporate Decoder. Today, ALLSPRIING Master Trust just filed an N-CSR report, and I am seeing a deep dive into their shareholder performance that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The filings reveal detailed performance data for several portfolios over many years, giving us a great look at trends. Alright, let's start by looking at the ALLSPRIING disciplined large cap portfolio. This filing covers the period from May 2025 to April 2026, and it really shows us how the investment world can be a roller coaster. This is a key takeaway for the disciplined large cap portfolio. They underperformed their benchmark, meaning investors in this specific portfolio did not do as well as they could have if they had invested in the benchmark index instead. Let's look at the numbers for this portfolio. Imagine you invested $10,000 on the 12th of June 2018. By the 30th of April 2026, that $10,000 investment would have grown to about $29,589. That sounds good, right? But the benchmark indexes, the Russell 1000 and Russell 3000, turn that same initial $10,000 into about $28,657 and $27,863 respectively. So while the personal investment grew significantly, it grew less than the benchmark, confirming that underperformance. When we look at the average annual returns, this underperformance is clearer. Over 1 year, the portfolio returned 30.12%, while the Russell 1000 returned 30.42% and the Russell 3000 returned 31.01%. Over 5 years, the portfolio returned 14.01%, the Russell 1000 returned 12.32%, and the Russell 3000 returned 11.91%. And since inception, the portfolio returned 14.75%, while the Russell 1000 returned 14.29%, and the Russell 3000 returned 13.88%. So the portfolio did better than the benchmarks over the long haul since its inception in 2018. But it lags slightly in the 1 and 5 year periods. The disciplined large cap portfolio has total net assets of around $349 million. The portfolio turnover rate is about 30%, which suggests a strategy that is not overly aggressive in trading, aiming for more of a buy and hold approach perhaps, but with some adjustments. Now, what was this portfolio investing in sector? Why is information technology is the biggest piece at 33%. This makes sense given the current market focus on tech, but it also means the portfolio is heavily exposed to the ups and downs of that sector. Financials come in at 12.4%, followed by communication services at 10.7%. And industrials and consumer discretionary both at 9.4%. Looking at the top 10 holdings, we see a heavy concentration in tech giants. Nvidia Corporation is the largest holding at 7%, followed by Apple Incorporated at 5.8%, and Microsoft Corporation at 4.5%. Amazon.com Incorporated is at 3.8%, and Broadcom Incorporated at 3.3%. It is clear this portfolio is riding the wave of large cap tech growth, but this also creates significant risk if these tech giants falter. Next, let's decode the macro strategies portfolio. For the period from May 2025 to April 2026, this portfolio actually outperformed its benchmark. That is a positive sign. This portfolio strategy is quite different from the large cap equity focus. It is heavily weighted towards US Treasury securities at 78.2%, with only 21.8% in common stocks. This suggests a more conservative capital preservation oriented approach, aiming to generate returns while managing risk. The top holdings are all US Treasury inflation, index notes or TIPS. The largest holding is a Treasury inflation index note maturing in July 2035 at 3.7% of net assets. This focus on Treasury securities and TIPS means the portfolio is designed to perform differently from equity. Heavy funds, especially in inflationary environments. Now, let's dive into the small company value portfolio. For the same period, May 2025 to April 2026, this portfolio underperformed its benchmark. Looking at the top 10 holdings, we see companies like Patterson, UT Energy Incorporated at 1.3%, followed by Kaiser Aluminum Corporation also at 1.3%. These are smaller companies, and the value-oriented strategy suggests a focus on companies that may be undervalued by the market. Sector allocation shows industrials at 22.6% and financials at 20.7%. Information technology is much lower here at 12.6% compared to the large cap portfolio. This diversification across sectors and focus on smaller, potentially undervalued companies is characteristic of a small cap value strategy. Moving on to the core bond portfolio. This portfolio outperformed its benchmark for the period from May 2025 to April 2026. Scroll portfolio allocation, percent of total investment. Capital the portfolio is heavily invested in agency securities at 37.9% and US Treasury securities at 25.8%. Corporate bonds and notes make up 23.3%. This aligns with a core bond strategy, aiming for stable income and moderate capital appreciation. The top holdings are primarily US Treasury notes with varying interest rates and maturity dates, such as US Treasury notes with a 3.88% interest rate maturing in April 2031, making up 2.5% of net assets. This heavy allocation to US government and agency debt highlights the portfolio's focus on stability and income generation. Finally, let's look at the disciplined international developed markets portfolio. This one also outperformed its benchmark for the period from May 2025 to April 2026. The country allocation shows Japan as the largest holding at 24%, followed by the United Kingdom at 16.5% and France at 12.1%. This international focus means its performance is tied to global economic trends outside of the United States. The top holdings include ASML Holding NV, a Dutch company in the semiconductor equipment sector at 2.5%, Siemens Energy AG from Germany at 1.8%, and Novartis AG from Switzerland at 1.7%. This mix of established international companies suggests a strategy focused on quality businesses in developed markets. Looking at the principal accountant fees for the fiscal year ending the 30th of April 2026, the audit fees were about $308,000. For the prior fiscal year, they were higher at around $366,000. There were no audit-related fees or tax fees reported for the most recent fiscal year. Although there was a tax fee of about $80,000 in the prior year, this suggests the majority of the accounting firm's work for the current year was focused on the audit itself. Now, let's decode what is really going on behind these numbers in the Allspring Absolute Return financial statements. This fund operates as a fund of funds, meaning it invests in other funds to achieve its goals. As of the 30th of April 2026, the fund's investments are heavily concentrated in investment companies, making up 98.97% of its portfolio. A significant portion of this, 58.75%, is invested in affiliated master portfolios. This means the fund is essentially investing in other funds managed by the same parent company, Allspring. Specifically, it holds over $220 million in the Allspring Macro Strategies portfolio, over $25 million in the Allspring Disciplined Large Cap portfolio, and over $20 million in the Allspring Disciplined International Developed Markets portfolio. This structure, where a fund invests heavily in its own affiliates, is common in the industry, but it is important to understand the potential for related party transactions and fees. The notes to the financial statements clarify that these affiliated investments are valued daily based on each fund's proportionate share of the affiliated portfolio's net assets. This is a standard practice for fund of funds structures. The notes also detail that the fund intends to qualify as a regulated investment company, meaning it distributes most of its income and gains to shareholders to avoid corporate income taxes. For fair value measurements, the report indicates that investments in investment companies are valued using quoted prices, which is level 1 in the fair value hierarchy. This suggests these are typically liquid investments valued based on readily available market prices. The Allspring Absolute Return Fund has total net assets of about $454 million. The management fee rate is tiered, starting at 0.225% for the first $1 billion in assets and decreasing for larger amounts. For the year ended the 30th of April 2026, the management fee was equivalent to an annual rate of 0.225% of the fund's average daily net assets. This indicates that as the fund grows, the management fee rate slightly decreases, which is a common structure. Total return for class of shares for the year ended the 30th of April 2026 was 25.59%. This is a strong return indicating solid performance for the period. Scroll now, looking at these results more broadly, what is my take on ALLSPRIING Master Trust's filings? It is a mixed bag across the different portfolios. The large cap equity portfolios show strong recent growth driven heavily by tech, which is both a strength and a significant risk. The core bond and real return funds appear more stable, focusing on income and inflation protection, which is important in today's economic climate. The concentration in affiliated funds within the Absolute Return Fund is notable and something investors should be aware of. It is a common strategy, but it means a large part of the fund's performance is tied to how well other Allspring funds are doing. The high turnover rate in the core bond portfolio is interesting, suggesting active management in a typically more passive sector. The small company value portfolio's underperformance against its benchmark. in the short term is a point to watch, especially considering its high turnover rate. It highlights the challenges of finding undervalued small companies in a market that sometimes favors growth over value. The consistent outperformance of the disciplined international developed markets and macro strategies portfolios against their benchmarks is a positive signal suggesting effective active management in those areas, especially given the geopolitical and AI-driven market narratives mentioned. The key risk I am watching is the heavy tech concentration in the large cap equity portfolios, which could lead to significant volatility if market sentiment shifts away from growth stocks. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives and join our Discord.